Hi, today is Sunday, the 1st of November, and this is a weekly recap. And this has been a pretty difficult week. Not so much for the November trade, which I'm showing here. As you can see, let me show you the trade log. We haven't done that much on this trade, but basically last week, that was on the 29th, I dropped the put side completely, and I put down a PCS, not at a great price. I got a 1.2 for this, and with the market dropping afterwards, that was not such a great entry. I suggested on Slack that there are several possible adjustments to remove risk on either side or completely. Basically, at this point in the trade, that is your call. So now this trade has got just the PCS here with a short on 2800, pretty safe, and my short calls are very safe on the upside of 37.25. If I reduce a little bit and I show, let's say, to expression, we see that with the volatility being this high, this is not actually a safe trade. It is still safe at plus minus 1 SD. So for my type of conservative trading, I would still try and close by 14 DT. So somewhere around here next week. And I may even close it earlier if I'm tired of this trade and if I want to focus on the January entry. Generally, I don't like keeping 3 cycles on. So this trade can be closed. I wanted to protect $800 anyway, so this is cool. I may just close it. I may keep this 30 cents here. Maybe I would get to, if I close it for $800 on Monday, I'll close the downside. I would still probably keep just a short CCS on there. Okay, so not much to say, not much to do. This trade is fairly safe, and basically, unless elections are contested, so without any political endorsement, and really, it seems that if Trump gets a very clear victory, the market will be really more relaxed, the volatility will drop, and we will probably get a better return on this trade. So now let's move on to December. This trade is not doing this great. I mean, this is not a very easy type of trade at the moment. I've done a little bit more on this trade lately. If you see on the 26th, 28th, and 29th, I started rolling back conservatively because volatility really shot up. My initial iron condor was a mistake. Here was my iron condor, shorts on 31.25, long on 3100, and then adding a CCS up there. That was not such a good idea. So 2 days later, I reversed this. So basically, this combination of two adjustments cost me about $160 or $1.6 on a combo. And then on the 29th, I started rolling back. As you can notice, because when the market falls, liquidity is not so great, and also to be on the safe side, I swapped my usual broken butterflies for balanced butterflies. That felt a lot easier. I'm quite happy with the way the trade is looking right now. This is worth nothing, so I would probably try and bring them down or close and maybe wait for, as you can see, that will not change much in terms of delta, but still, the more important thing is that I still have a lot of Vega coming from this corporate spreads. So I may just really reduce. Of course, there's some theta here, but if you look at it, I mean, it's only $1.6, for 40 cents, so times 4. So the right thing to do if the market drops is just to close them and maybe reposition them later. Obviously, would prefer keeping a negative delta, but this is a flattish of delta. I have more fairly market neutral rollbacks planned for next week, and that would be to reduce this now condor here. As you can see, I have a wide condor, and it's also because if the market keeps going down, I wouldn't want to have to deal with an ITM put. I mean, those don't fill easily. I mean, volatility is high and pricing is more accurate than it used to be. Let's say I will keep an eye on liquidity on those ITM puts. So if I was to do something like this and maybe adding another balance fly here, That would be something that would bring the break-even point at the downside to about 28.50, and I would have no upside risk. Of course, the upper expansion line would suffer a little. I would have still a flattish delta, and my capital usage remains quite modest and safe for this type of environment. Once we get more clarity, I would definitely add back some capital. Volatility may subside after the elections because, of course, risk is a measure for uncertainty, and regardless who wins, there will be most probably, at least at first, a drop in volatility. So going slightly delta positive is also the consequence of this very high volatility environment. So I would not be too concerned. But let's say that if the election is disputed, if the incumbent candidate doesn't want to step down, we could be in trouble. It could be a resurgence of volatility way above 40 and we would be in trouble. So I have to be very, very conservative here. Gamma is flat, delta is flattish, as you can see, even if it loses another 100 points. I mean, it went down to about 32.20 recently. Of course, there would be some effect on the P&L. It would go back to the minus 500, but they would still be safe. Now, if volatility goes sky high, it may be also a good idea to start implementing put calendars. Put calendars are generally placed as a hedge somewhere between the lowest puts or in the short. So it would be maybe somewhere around 2800, 2850. I would probably get just 1 month. There would be, of course, a trade-off to this kind of trade. Volatility would be reduced next to nothing. So that could be a good thing. Maybe you don't need to reduce Vega that much because I have reduced Vega in that instance. Maybe going for a very narrow. So if I was just to go for this, I would still keep very good theta. I would restore some negative delta, and this looks like combine this with the, as you can see, I reduce this completely. I can live with an upside risk of 800 or $900 because of course if the market was shooting up, I've got plenty PCS possibilities, PCS or PCS falls, but as you can see, my capital usage would be quite controlled. So I'm not worried at all. May not be a great month if the market shoots up, quite likely. Also, something you can see is that when you want to mitigate your Vega risk, it's not necessarily always too late because now you can play the theta. If the market doesn't fall to 2800 or 2850, this will drop very quickly. So these are probably easy $41 here. And if you're more concerned, because still your theta is not that great yet, we're still 47 days, another possibility would be to actually move it forward and it would go maybe for November here. As you can see, when you push the calendar hedge earlier, it changes the overall shape of your trade. I mean, it's of course that's the way it's calculated because now all of a sudden the November expiration becomes the main one. So if I was then to put it for December, that would probably be something, yeah, that would be something closer to reality. This is of course still incorrect because this is assuming that the short of November is expired. Definitely, if you want a short-term hedge, you would get more negative delta, Vega push. You lose your theta momentarily, but then your shorts from November 30th would expire quicker. I mean, you have a month. And that's when theta accelerates. Right, so that's it for the possibilities. So I will consider a Vega hedge as well, but as you can see, it's probably enough to stay in a same expiration with. So not to be confused, let's go back to the initial potential adjustments, all in the same month of December except for a regular calendar December, January. Sorry if I confused you a little earlier. So dropping the CCS, a short condor here to reverse some of it, and a rollback with one balanced butterfly here, 2800, 2900, 3000. and just a put calendar 28.25, but it could just as well be 28.50. 28.25 will be slightly cheaper. So this is more or less what it would be like to be really safe. Turning Vega positive, we may not need to go Vega positive, but at least we would restore some good theta. The calendar would give us good theta. But I suggest we can of course drop this one and you can compare which one you like better. Keep some Vega, negative Vega, but not that much. There's the problem here is we lose a lot of theta. So this may be safer in case there's a storm coming. Right, I think I've been a bit too long on this December trade. January entry would probably be very safely positioned, far out of the money, one or two, and it could be something on 28.50, 29.50, 27.50, and 26.25, just to have a little bit of negative delta, very little Vega. And of course, because the Vega would be here, so it would definitely start dropping a little bit if all really goes sky high. And not that it would help very much on the Vega side, but it would redistribute Vega if I go for a more balanced structure here, with the Vega being more spread out across the range. So that's something that we could do. I was also considering here as well a balance fly, which in this high volatility doesn't cost that much, and we can contract also with some call credit spreads here. But I would be okay with having my risk on the upside, at least in the beginning, and maybe later buy a PCS here or further up to rebalance the trade. So this one would have, in case of a market dropping very sharply, this would be a very good hedge, at least at first. The other possibility would be keeping the trade entry small, would be to have one of each, something that would be also pretty safe all the way down to maybe 26, 2700. And as you can see, it's a very small margin. Delta would be, I would probably here again balance it further with more risk on the upside. So this could be a good attempt at entering January. I will discuss that on Slack, and for those who are not there yet, it's called bwbflies.slack.com. So please join them, and all the channels are open and public. Thank you for watching. Sorry this video was a bit longer, but markets warrant more analysis. It's not an easy market, but it's also a good opportunity to learn. And Vega has so far been a good opportunity. We just have to be a little bit more cautious about it. But this is, to me, not a reason to stay on the sideline. Okay, enjoy your weekend and see you on Slack tomorrow. Bye for now.